Jamie Dimon, Chairman and Chief Executive of JPMorgan, has conducted a thought experiment. The results aren't very pretty. He suggests that in a new financial crisis there would be a serious lack of liquidity because of tougher capital requirements. I'm here to discuss that with Mike Mackenzie, Markets Editor. Mike, is this just a tempest in a teapot, as Mr. Dimon once termed a trading scandal in London, or has he got a point?
Well, he makes some very interesting points, but at the same time, let's rewind back to 2008, at the height of the financial crisis. There wasn't a great deal of liquidity, and in that time, banks were the dominant providers of liquidity. So every time you get any kind of turmoil in markets, guess what? Banks always pull back. I mean, for example, last October, we saw a massive drop, short-lived drop in Treasury yields, and they then came flying all the way back. Again, no one was prepared to step in. Now, when you look at the regulatory world post-financial crisis, banks can still trade and hold treasuries. It's one thing that's exempt under the Volcker rule, but they're not prepared to step in like they used to. So some of the points he makes are very, very good, but he is being a bit self-serving.
Well, I think that's the next point to come on to, really, because JPMorgan has been hit with tens of billions of dollars of fines for legacy issues relating to the crash. There's also an issue, I think, which has been raised by analysts about whether it is too large and should be broken up. Isn't this a bit of Mr. Dimon talking his own book?
Well, sure. Look, he's the CEO. He runs one of the biggest banks in the world. They're a very important player. In fact, you could argue that during the crisis, they were lent on by regulators in the US to bail out other banks, such as they bought Bear Stearns, for example, at a knockdown price. He also has had to pay a lot of money out for fines that comes from legacy purchases of troubled institutions from the financial crisis years. But I think ultimately JP faces a very different financial system. The regulators have quite clearly decided after the financial crisis they're going to regulate banks hard, because at the end of the day, what was the main takeaway from the financial crisis was that during the good times, all the traders working at these banks got to make massive bonuses. But when the markets turned and we had all the turmoil and all the massive losses, those losses got socialized and were picked up by the taxpayer. Now, the regulators, particularly in Washington, they don't want the taxpayer to be on the tab again. Next time around, there's turmoil. What they would rather see, and what they have, and indeed what they have created, is a system where the banks are ring-fenced now, and as Jamie Dimon says in his sort of thought experiment, the banks are stronger now. They have more capital, and they won't be at the forefront of the next crisis. On the other hand, the people who will be in the forefront of the next crisis are very well all the investors who've piled into bonds yielding next to nothing in yield, all the people who've gone chasing in the search for yield into all types of exotic products. And they're the ones who bear the cost. But importantly, the taxpayer will not bear the cost.
And that's got to be a step forward. I suppose if we can find a synthesis in this, it might be in changing the rules at the margins to make them a little bit more flexible in a high-stress situation, which is one of the things that he suggests. What do you think of that?
Well, I think JP would love a world where they could actually step in as the buyer of last resort. It's going to be a lot harder for them if you do see big moves in asset prices and big dislocations for a bank like JP to step in and suddenly be that buyer of last resort and over time make a great deal of money. They no longer have an internal prop trading shops within the banks. What we are seeing, what we have been seeing for the last few years, is a number of hedge funds and alternative asset managers stockpiling money, and they call this patient capital. And these are the players who, if you do see a big move in the markets, they will step in and they will buy these assets at knockdown prices, and over time they will recoup their money and make a substantial profit.
And the beauty, one might think, there is that they can go bust if they are in difficulties decently and quietly without losing a lot of customer deposits.
I think the real issue here, and what Jamie Dimon's trying to get to, is the fact that the system has changed, and unlike the past where you'd see financial turmoil, a bank like JPMorgan could step in and buy assets that had been knocked down so far in value and basically ride them back. And under the new regulatory system, that's not going to really happen. What you're going to see, and what we are seeing, are a number of hedge funds and alternative asset managers stockpiling money, and they call this patient capital. And effectively what they're saying is that when there is a next financial crisis or moment of turmoil, we will come in and we'll buy bonds or shares that have been hit hard at bottom, fire sale prices, and will be the ones who make the profit. And that's really, I think, what's driving some of Jamie Dimon and indeed the general banking industry's sort of angst here, because those were the days when you made really big bonuses.
So where we could perhaps leave it is that October the 15th should give the financial authorities pause to wonder whether those new actors coming in as lenders of last resort are up to the job. Thanks very much.